Hi everyone, this is Ben with the All in the Reflexes Substack. You can find me on Substack as well as posting charts and ideas, typos and memes throughout the week on X. If you use the QR code, that'll take you to my link tree with those, as well as my link to TradingView, where I'll occasionally post some of the charts as well. So I want to go through a video analysis of our video update of the market timing tools and upcoming potential catalysts that we have in the marketplace over the next week. I won't do a group call this week, but I'll be at the Cycles conference on at the end of the week. If anybody's going to be attending that, look for me there. We can grab a beer and chat. And I'll do another broad market update as a video update when I get back, and then we'll look to host a call where we can just do live chart requests and ideas together, and that way we can keep the calls more interactive and less focused on just the the general market updates. So this week let's take a look at some of what we have coming up. This is kind of a quiet month for me on my seasonal playbook. If anybody wants a screenshot of this is not a recommendation for anyone else. None of what's talked about on these is a recommendation for others. This is just a kind of an open record of the way that I see things that I may or may not participate in personally, but everybody's skill set, interests, risk management is going to be unique to themselves and their process. But I just want to share what I see and do and what works for us. But June is a month that is really slow for me for seasonality perspective. I don't have new positions that I take on thematically. I will continue to participate whenever I see a very strong individual chart, but I don't have things that I look to proactively take advantage of on a seasonal basis in the month of June. And I typically have a couple of things that I'm scaling out of and start to scale out of, like energy and semiconductors. Both of which I'm out of right now. I actually think energy might be interesting to start to take a look at. And then July, I may look to begin shorting semiconductors. I'm not sure yet. We'll have to see what those charts look like. Gold is, one that I start to take a seasonal position on in July, but it's already run really, really hard. So we'll just have to take a look and see what the charts are telling us when we get there. Taking a look at this, some upcoming news for this week. So we've got last week's economic data. The largest data prints last week were labor, and I would say labor looks moderately favorable. You're not seeing, strong hiring, and you're not seeing strong cutbacks either yet. So it wouldn't take much to shift this into an unfavorable labor market. This is typically something that is going to benefit. The greatest benefit in a labor market like this goes to people that are currently in positions it's not as favorable for new grads or people that are in the marketplace looking. So if conditions should worsen from here, then I would expect to see the Fed start to adjust rates, but we'll keep an eye on this, and the summer months are usually tough on the labor market to begin with, so we'll keep an eye on this. This week we've got CPI and PPI coming out. These are not the Fed's preferred measure for inflation. They prefer PCE. These will still be meaningful catalysts for the market, and we'll see news analysts reading into them and trying to read the tea leaves for what the Fed will do in the following week. But we already know that the Fed is driven by PCE, and they're probably wrestling with how much political pressure they're getting on rates right now. We've got preliminary consumer sentiment coming out at the end of the week. That's gotten a lot more airtime with the media than it has, because the figures have been relatively unfavorable. So we'll keep an eye on that. And then the next Fed rate decision comes next Wednesday. So that'll probably be the largest economic, macroeconomic catalyst that we see in the coming weeks. Earnings season is largely behind us. The majority of large companies have reported, and so far earnings has gone pretty well. This week we've got really not much of interest. You've got GitLab, GameStop, Academy Sports is one I used to have a position in. Chewy should be one that's worth paying attention to. Oracle reports kind of late in the earnings cycle for the large tech companies, so we'll keep an eye on them, as well as Adobe. But yeah, really, not a lot of catalysts coming up in the earnings space for us. Seasonality has been interesting this year. It's not played out it is as typical as it has in past years, but June is normally a relatively flat month. July is the strongest month of one of the strongest months of the year for the marketplace in general, but it comes within a relatively weak 6-month span. So from a seasonality perspective, I look to put more participation on into October and November, and use this July opportunity for profit taking, and then just plan where I really want to be over the next year, over this over these quiet months, so to speak. But we know seasonality has not been typical this year, so that that raises a question for June. Will we see a weak June? Will we see a strong July? Right. So we'll have to let the charts tell us and play out. When we look at the seasonality on for just post-election years, we can see this is a little bit weaker at the beginning half of the year than an average year. Average years see a fairly strong April and May, and post-election years get off to a very, very slow start and then have a much stronger finish. That actually seems to be a lot of what we're experiencing, right? We had a very strong May. May was stronger than April, and that's really the case in post-election years, but not in the majority of years. And so this would lead us to believe that we'll see a decent July, but again, we'll let the trends dictate that, and not try to front run it after some of the volatility that we've experienced. At least I will. On a weekly basis, we can see that the month of June tends to be front loaded with the trend tends to be front loaded, and then it cools off and weakens to a finish. And I wouldn't be surprised if that was the case, but again, we'll let the charts tell us. And then July, your strongest period in July is toward the second and third week, and then it starts to cool off, and then cools off into these summer months. Looking at cross assets and trends in all of the asset classes, U.S. dollar index remains weak in all time frames. The treasuries, the 10-year is relatively weak, though saw a little bit of improvement towards the end of the week. The strongest asset classes right now are U.S. equities and gold remain very strong. And this movement from commodities, we've seen a lot of the analysts talk about how well silver has done, that palladium's picking up, that platinum's picking up, and that's stuff that we've been talking about for a while now. And so it's starting to get some recognition, starting to take off. What we're not seeing a whole lot of discussion on yet are agricultural commodities. Those are really what starts to move after the precious metals do. And so we've got a couple of opportunities that we can look at in there with like the DBA ETF, or I posted a couple of weeks ago about Nutrien NTR. That's a large position that I'm going to keep adding to on dips, and I think that's a multi-month, multi-year type of opportunity from this stage of the commodity cycle. When we look at our we're going to get into our timing indicators again. So this is the binary model that's just taking a score across breadth conditions, trend deterioration signals and volatility weighted put call signals. And right now this is a bullish stance for us to be in. The lower this score is, the stronger the potential for an uptrend, and once you've got an aggregate score getting above 18, then we're into like a risk off territory, and we're not seeing that right now, so that's good. Looking at them on this is the same chart, but they're breadth, trend, and volatility weighted put call scored individually. The trend deterioration score is a little bit noisy. I might rework this to try to get a more isolated signal from it, but it's okay to see clusters of signals, especially if they don't get past the midway point in isolation. It's when we see them pop up in conjunction with warnings in breadth and warnings on volatility and sentiment that we're seeing an indication that it could be a larger drawdown. We don't see that right now, so this is a sign in our weight of evidence that you've got some hesitation in the market, but that we don't have large headwinds fighting trend like we did back here in 2022, where you've got trend deterioration in your breadth measures, your volatility weighted put call, they just keep resurfacing. So if we see a condition like that, we'll be concerned. But if not, the look right here reminds me a lot more of what we saw in September of 2024 than it does of May of 2022. When we get into the scoring model, or the market timing tools and our weight of evidence, so we've got 10 data points that I like to keep on the radar. This is the best that their statuses have looked since the beginning of the year, and we've got 7 in the green, 2 are still yellow, and 1 is red. So you've got the 5% drawdown is my primary signal. This is a trend in momentum, or like a trend in rate of change type of indicator. S&P 500 above versus below its 200-day moving average, along with how many of the individual companies are above and below their 200-day moving average. That's a breadth and trend measure. Volatility weighted put call is volatility and sentiment. Fabian market timing model is a trend model. Fisher and Kopic are both trend and rate of change on a high time frame. Equity commodity model is a cross asset and rate of change model. New highs minus new lows are a breadth measure. Selling climax is a breadth measure. Extreme vulnerability is also breadth. And then last but not least, the index momentum is using a multi-time frame momentum model to identify transitions in the marketplace. So the two that are yellow right now, the S&P versus its 200-day moving average and the number of companies above below. Once this is below, once this is to like 50%, like 55% or better, or lower, in terms of the number of companies that are below their 200-day moving average, that's when we're going to flip this one to green. So it's just super close, and it's been very stubborn. The Fisher-Kopic model is going to remain red realistically for at least another 2 weeks, maybe even a month, because it's on such a low or such a high time frame, and that's okay because this one's a conformational indicator. And then the index momentum model is yellow, but that's based on the RSI for the weekly, and again, it's a very slow moving type of indicator. We'll have to make we'd have to see like a 5% week out of the S&P to clear this in the coming week. So I expect that this will stay yellow for a little while, and that's going to be okay as well. We'll take a look at them individually. You've got the 5% drawdown. We can see everything's cleared. This is a false signal that's flagging in yellow, and I'll have to look at the code to see why it's doing that. But you've got the relationships of the major moving averages is all very favorable, with the exception of some challenges in the Dow, which we need to continue to keep an eye on. Again, this is that stubborn S&P 500 versus its 200-day moving average, and how many companies in the S&P 500 are above and below their 200-day moving average. So you're like right at 56%. So you got about 282 companies that are below their 200-day moving average. Once that gets to 275 or better, that's the signal that tells us that we're going into these longer, sustained, steady uptrends. You don't get as many false positives when both of these indicators are green, and that's what we're looking to see. You can try to be a hero and get in at these lows. That's very lucrative if you're good at it. I prefer to, when it comes to broad participation in the marketplace, I prefer to have confirmed recoveries and uptrends that I participate in, and leave positions on for as long as possible to maximize the benefit of lengthy uptrends, and avoid the potential risk of multiple shakeouts and washouts like we saw in 2022. The volatility weighted put call ratio is combining the VIX, the Williams VIX Fix, ATR, and the put call ratio into a single indicator. The top version is an RSI version of it. The bottom is a stochastic, and one is a leading indicator and the other one's a lagging confirmation. Though you could make a strong argument that the lagging confirmation version of this indicator is leading us, is a leading signal. So this is giving us, basically an alert and a confirmation, and helping us to avoid drawdowns and re-enter uptrends very quickly. So I'm going to continue to work with this and document the findings on it. But what I'd like to highlight is we've got a crossover on the moving average for the slower iteration of this indicator that uses the stochastic measure, and you notice that when this moving average moves above zero, it doesn't come back below it very easily. You don't have evidence of a lot of washing out and shaking out in this indicator. Now trend can, we would have gotten this as a bullish signal back here in August of 2022, and we would have been pretty excited, and then it fails, comes down, makes a new low, and so we can say the indicator's not doing its job for us. But you've got your signal, you've got your warning, and then your confirmation, and you can avoid some of this drawdown. But realistically, even if you entered on this as a signal here and experienced this drawdown, you're still at the start of a really long uptrend, and it continues on from here. So this is a bullish crossover. The faster moving iteration of the indicator is already bullish, so this is confirmation that we're in what is likely to be a sustained gradual uptrend over time. Next data point in the weight of evidence, the Fabian market timing model is probably a bit more boring for us, because this is using 39-week moving averages, and it's looking for the S&P, the Dow, and Dow Utilities Index to fall below that 39-week moving average together to give us our risk-off signal. They're all bullish right now. The slope of the 10-week moving average is not positively sloped yet for the Dow and the S&P, but it's above those moving averages. On an individual cycle basis, the cycles for the S&P and the Dow are below zero, but the Dow Utility Index is above. And what I want to highlight here is this is a combined, a composite cycle of the S&P, the Dow, and Dow Utility Index, and it's crossed above its moving average, or it's trending. Now, this is a very smooth indicator, right? So it's trending towards a bullish crossover of its white moving average, and in the past when we've seen that, that's been accompanied with long, steady uptrends in the marketplace. You've got its crossover here at the tail end of 2022. This is like people were still very, very bearish at the end of 2022, and 2023 was an incredible bull market, and we can see this crossover. Now you've got a little washout here in the middle of 2022, comes back below and then back above, but this crossover tends to be followed by long, steady uptrends. Crossover after the well after the bottom of 2022 gives us confirmation, a crossover, long and steady uptrend. That's why this indicator has a high win-loss rate, high average trade rate, and a low number of trades. It's just getting you into trends and keeping you with them for a very long time, and avoiding these lengthy downtrends. So that's what we're looking at now. Is we're headed into a bullish crossover, and we'll keep an eye on that. The Fisher and Coppock model. This is a 2-week time frame, so it's very slow, which is again why it's got a very high win-loss rate and a high average trade rate and low number of trades. So this is going to stay risk off likely for a long time. Probably, I would say we're probably at least a month away from seeing this flip bullish again, and that's okay because this is a lagging confirmation for us. The market's going to be what I would consider to be safe for myself to participate in very broadly once this is back into a bullish stance. The equity commodity model looks very strong. This has 3 signals that would tell us that it's risk off. If the rate of change for equities and for commodities falls below 0, that would be a risk off signal. If the spread between the rates of change of each of them was too large, that would be a risk signal. And if commodities, when adjusted for inflation, were below their moving average, that would be the third signal. None of those are firing right now, and we can see the commodity momentum indicator has been trending positively, got above 0, retested it, and is above its moving average. This is a very bullish, gradual uptrend for commodities, just like we saw, back here in 2019. It doesn't always mean that the broad commodity index is going to be the place to be. We want to be very selective with which ones we go after. But again, this as a market timing model is telling us that it's risk on. And when we look at now we get into the series of breadth measures. We've got the new highs minus new lows. This is on an ongoing cumulative basis. We've got another version of this indicator that's on a rolling 10-day basis, and then just the NYSE total volume. Now, pointed out a couple of things. We saw the cumulative new highs, new lows start to flatten after this bearish crossover, and we saw a higher low in the S&P headed into its major moving average. We had a bullish crossover on the 10-day rolling new high minus new low. We saw that same situation back in 2022, and we said, this doesn't mean we're out of the clear. If we saw a failure at the moving average and a return to the downtrend, that could be our risk signal as a failure on these moving averages. We blew right through these moving averages, came up and tested them as support. So this is bullish. The next thing we'll point out is we've got a waterfall down in price in these downtrends and a spike up in volume. When that volume peaks and rolls over and falls back below its moving average, this confirms that the downtrend is behind us. And now you've got gradually slowing volume as more and more participants are drawn into the market, and this brings us into these long steady uptrends. And again, that's what we're seeing on the prior charts is where is evidence that we are headed back into a long steady uptrend, and these are not without their pain, right? You've got these are, because we're zoomed so far out, it looks like, it is a long steady uptrend, but you've got a lot of pain in here. You've got 5 and 10% drawdowns all over the place, but this is still a bull market that you want to stay in, or that I like to stay in and not get shaken out of, and that's what we see begin after these large volume spikes exhaust themselves. So this is very bullish looking for me. Additional breadth measures, you've got the advanced decline line divided by its moving average with a Bollinger Band on it. When it starts testing that lower Bollinger Band, that's when you've got risks of a drawdown, and we're not seeing that. We're seeing it test the upper level of its Bollinger Band little bit of concern in here when it starts to pinch like that, but it's curled back upwards. So this looks bullish to me right now. You've got the selling climax indicator on the bottom half. This is a bearish signal when it gets above 4% for intraday new lows. We're not seeing any of those. We haven't seen one since April. So again, this is very bullish. Looking at the extreme vulnerability breadth measure, this is the number of consecutive days that we've gone without an extreme low and net new lows, and this is getting multiple resets, and multiple resets are what we see, at the onset of, again, these long steady uptrends. You'd start to accumulate a number of days without an extreme new low and new lows, extreme low and new lows, right? If we had more volatility or an additional drawdown coming up in front of us, and we're just not seeing that. So this looks bullish. And then last but not least, we've got our multi-time frame momentum model. If you guys follow Brian Swan, Fibbo Swanee on X and on TradingView, this is his system, and it's done very well for me. I especially go back to it in challenging markets because it's just it makes the most sense for my mind to process trend and opportunity. So we're looking at the ADX, the average directional change, and the white line is how strong the trend is. The green line is positive, and the red line is negative. So on the right, you've got a 1-day chart, in the middle a 1-week chart, and the left is a 1 month. And then you've got your relative strength index on the bottom. And so relative strength in the daily is in bullish territory. The trend is cooling. It's getting into like anything below 20 is not necessarily bearish, but this tells us the trend is not overly strong. And so that uptrend is cooling a little bit. This might give us a retrace back to test a level of support, and that would be okay. I'm going to view that a scenario like that as a buying opportunity for myself. On the weekly, the downtrend has now cooled. The negative ADX is below the ADX, which tells us that the peak fear is behind us, and the RSI is starting to trend upwards. It would have to get above like 6,300 to push into bullish territory over the next week. So that's kind of a big ask for the market, based on seasonal history and us seeing the trend on the daily cool a little bit. But all things are possible, so we'll keep an eye on it. The monthly has never come out of bullish territory, though we do have ADX rolling over and the negative directional index rising above both the ADX and the positive directional moving index. That's typically bearish, but it could reverse again given what we're seeing on the lower time frames. So this looks bullish to me, but potentially cooling off a bit, and if it does cool off, that's probably we're going to look for it to come back and retest a level of support and give us additional confidence in the marketplace. But these signals are trending favorably right now. I love the sentiment cycle. We see this, once you develop an eye for it, you're going to see this pattern all over the place in the market, and you can use it as a guideline. Sometimes it's tough to tell, are we in panic or are we in despair? Like that's usually where the confusion comes, but you generally don't get into a situation where like, are we in panic or is it returning confidence? Like that's generally not where the confusion is. It's which of these two levels could it possibly be? When we look at the S&P now, this chart, I've got multiple Gann timelines. I've got a Gann timeline from the all-time high, and I've got a Fibonacci timeline that goes from the swing high to the higher low on April 21st, and I'm going to see if these are anchors for sentiment for the market in the coming weeks. Eventually they exhaust, and no longer hold meaning for the market, but for the time being, it looks like the market is, in an ebb and flow from the timeline that's anchored to the all-time high, and it may or may not also be drawn to the Fibonacci timeline from the swing high to the higher low. We do see some. You've got that gap up in the middle of May coincides with a time zone on that on the Fibonacci one in days like these two, where the Gann timeline and the Fibonacci timeline are lining up with one another. You've got like a 2-bar into a gap up. So these things tend to be sentiment anchors until they're replaced by a different catalyst. But what I want to focus on is the shape of this, like the pattern. So you've got, if we were to look at the, if we were to look at this in the context of, let's pick a good color. We'll just use like a purple, right? If we were to look at this in the context of the sentiment cycle, you can see this subtle warning and overt warning, coming in as the market begins this drawdown from the all-time high. You've got something like this going on, where you've got like a low into the all-time high, you break trend line, and now you come down and you've got another trend line from a low to a low, and you're breaking through that. So you've got your subtle and your overt warning. The anchored volume weighted averages are preferred for me to fixed drawings and diagonals. You've got your failure up into this anchored weighted moving average. This is around the time frame that we get the confirmation on the 5% drawdown. You get your confirmation in March, and we started talking about looking for a tradable bounce. We have that right into the anchored volume weighted average at the end of March, and that's your, in hindsight, that was our panic, right? And we go panic right into despair, and despair takes us down to the bottom, and now we've come back up, put in a higher low, and that looks like our wall of worry, anxiety into aversion. And so now the question becomes, are we in denial? Was denial here? And this is us on our way to returning confidence. It looks kind of like we're here, right? So you've got the failure into the AVWAP. Your low of the movement was despair. We come back up, break through wall of worry and anxiety, come back down into aversion. And so I guess the question becomes now, are we in denial or returning confidence? And that's what we want to, that's the frame of mind that I'm going to keep as we proceed in June. So if we're, seeing normal seasonal slowdown in trend towards the end of June, and then pick back up in July, and then come back down at the end of July, like those could be the things that we see, as trend recovers and gets into returning confidence. But it's certainly not, I wouldn't classify what we're seeing in the market as like enthusiasm or exuberance. So this tells me that we have, I'm looking at this as an opportunity for trend to continue, but again, gradual trends are not without their pain and challenge. So those pullbacks into June and July, if we see them into the August and September periods, I'm looking at those as opportunities to participate in the strongest names that I want to be in for the long term, and this as a market event that that goes into our rear view and is the tailwind to a stronger and steadier trend. So that's how I'm reading things right now. Tom McClellan had a great quote recently on an interview where he said, strong opinions loosely held, and that's how I want to feel about this. We've got these anchored VWAPs from the all-time high and the low. We'll keep an eye on the relationship to those, see if they're meaningful in the future, if they come back down for a retest. But I'm looking at this as I'm not seeing evidence of additional deterioration. If anything, it should play out as a seasonal experience, and a long-term trend that I want to be part of in the coming months. So if anybody has questions, comments, feedback, please feel free to reach out to me directly or in the comments. But thanks for watching, and thanks for being a subscriber. Bye.